go ahead, record to this computer. Oh, he's still joining. Okay, let me. Atabek, remind me to post both this one and CSS, okay, right after this meeting. Okay, so when we're talking about backdoor conversions, okay, backdoor conversions, we need to go back to basically reasoning, right? Why do people do actual backdoor conversions? Well, because first of all, um, some people can't contribute to Roth directly. What is Roth? These are post-tax contributions, meaning person has spare money, okay, they do want to start some kind of retirement plan. They do not want to pay tax on that retirement plan in the future. So Roth is always post-tax, meaning, let's say the person had W-2 income, they don't get a perk from contributing to Roth. Well, why wouldn't, they contribute always to Roth? Well, because there's a cutoff, okay? Cutoff to contribute to Roth is around 150K of modified gross adjusted income. Now, don't specifically focus on that 150K number. You can look up the number in Google. You're going to get the precise one. If you're going to keep every single threshold number in your brain, you're going to go cuckoo, okay? So Google that exact number. But if the person is asking you, hey, can I still contribute? If you actually go into deductions, adjustments to income, and if you're going to input, let's say you're going to go to the Roth IRA, and let's say you're going to put maximum here. This is actually, that's could be fine, but we'll talk about this in a second. So if you're gonna put ones in here, okay, what that's gonna show you is if the person can actually contribute or not. It should create informational diagnostic. But always check, okay? Just Google. Google what is that modified adjusted gross income, then click on review tax return, and you're gonna see it's gonna give me 1 second. It's going to populate worksheet for you, whether they can or they cannot, and it's going to calculate the thresholds. This is how you determine whether they can contribute directly to Roth or not. If you arrive at a conclusion that they cannot, what they can do is they still can have post-tax retirement plan. Okay, post-tax retirement plan, which is again Roth. They just can't do it streamlined. They can't contribute directly to Roth. So what has happened, there is a loophole. What they do, they first contribute to a traditional, okay, traditional IRA, which in certain cases, mind you, it's not that they can't if their adjusted gross income, well, modified adjusted gross income is under 150, they still can contribute to a traditional. They, in fact, can contribute to both at that point, traditional and Roth. But a lot of people want to stick to just one, okay? And ideally, because their reasoning is, well, when we retire, we could have other income, such as Social Security, such as potentially capital gains, because they're going to have lots of investments accumulated by then. So the lesser the tax burden when they retire, the better. So they do want that to be post-tax. Now, um, what's the important thing to remember? IRA can be deductible. Traditional IRA contributions can be deductible. Will you guys see this with the level of clients that we have? Most likely not. Why? Because traditional IRA is deductible on the level of income of basically around 60K or less. Okay, 60K or less. Folks like that usually use free software like TurboTax. Okay, it also not only traditional IRA is deductible at that point if overall adjusted gross income is 60K or lower, they can also get savers credit. What's savers credit? That's a retirement plan contribution credit, which is wonderful. But again, will you see it? Probably not. Okay, probably not, simply because we do usually deal with the higher level income people. So, what's how can these people, when they have just even the wages, right, the W-2 wages of 228, how can they actually have post-tax Roth account growing and contributing to it? Well, they're going to be using the loophole. What's the loophole? It's a backdoor. Okay, it's a backdoor. What is a backdoor? Well, they're going to contribute first to a traditional IRA. Okay, traditional IRA. You're going to see IRA contributions here. They each contributed maximum 7,000, which is allowed for this year. Now, we do see that in previous years, they contributed into Roth. They realized that their income didn't allow them to contribute to Roth. So what they did in that same year, they recharacterized. Okay, so um, potentially, well, this is actually look back, maybe check if the recharacterization here is correct, because usually, or this is actually would be backwards scenario. So if they, I'm not sure why this is here. This is very confusing. Why do recharacterizations happen? It's if people contribute to traditional, but then they realize they qualified for Roth, they don't do the backdoor, they just recharacterize. Or let's say they contributed for 1 year, but then they actually meant to do it for a different year. For example, in 2025, because they still have till 4/15 of 2025 to contribute for 2024, they basically just double contributed potentially. They could have said, oh, we want to contribute to Roth and to traditional, and they incorrectly marked, okay, incorrectly marked that it's all for 2025, the year they're in. So that's when recharacterizations happen. But I think we're deviating from the point that I was going to make. So long story short, you're going to see here, always start with this screen and ask a client, hey guys, have you contributed to your traditional or Roth IRA for, let's say, 2024 tax year, or do you plan to? To which client is going to say, yes, absolutely. We actually have, and I do believe that, the recharacterization happened is because, yep, they contributed to Roth. This is at least the way I'm reading it. They contributed to Roth maximum. They realized they don't qualify. They had to recharacterize this amount so the penalty wouldn't trigger. And then we can see they recharacterized it to traditional. So you're going to see 2023 and early years basis is 6,500 because they recharacterized contribution for the prior year. Okay, so this is 2023 info and prior. Now, for 2024, they do want to contribute maximum $7,000. So what happens is technically they have basis of 13,500. Now, you can see here 2024 non-deductible contribution. What I usually suggest is I do suggest mock whatever you see here, provided they cannot deduct this amount. Why is it important? Because remember, guys, if it's 60K or below, roughly, the income, you will see that some of this is actually deductible. Okay? In this case, they're definitely above that threshold, so we don't need to double check the amounts. We don't need to worry about it. We know that the full thing is non-deductible. Hence, it turns into their basis. Okay? It turns into their basis. The basis grows. To read this, they have basically 13,500 in basis. Okay. There could be, it's asking here, well, are there other non-deductible contributions? Anything else? Payments from 1/1/25 to 4/15/2025. So this one, if they're going to contribute, if they contributed basically in 2025 tax year, why this is important is because ideally it should be matching 5498 form. Okay. 5498 form would be issued for the year that it happened. So technically, if they have contributed as of 1/1/25 to 4/15/25 for the year 2024, they're not going to have 5498. And so ideally, you put it here so Mr. IRS doesn't scramble and try to match, because otherwise they can disallow the basis. But this is more, oomphed up scenario. If anything, we can always say, hey, this is an honest mistake, right? The bottom line is, did they contribute 7K? Yes. Did it turn into their bases? Yes. Okay. Are we so far on the same page? Are you guys following me? How to basically read this screen and what to put on here? I need
Yes.
some yes, no, thumbs up in the chat. Please chat. Okay. So this is how we're reading this, right? It's how much in the year, okay? What's the prior year basis? And what is the non-deductible amounts, okay? Now, let's say they decide to backdoor the full thing. We go into the income section, we go into the pensions and IRAs. And this is what's super, super, super important, okay? In order for 8606 to be populated, you have no idea how many times some of you type and say, Lilia, no matter what I do, I follow your instructions, it's not populating. Well, first things first, check the thing, okay? If this is not checked, it's not gonna get populated. Okay, so the first thing that I would suggest you guys do is check if you actually checked this check mark. Okay, that was a mouthful just now. Then we take a look at what's happening. So we have actually a mix of things. We have what seems to be a distribution, and then we have what seems to be a direct rollover. So the question should be is basically you need to ask a client to provide a narrative, meaning, hey, I saw that you received 1099R, that, with actually for two different amounts. With this about this one, we're going to talk in a second. But with the two different amounts, one says direct rollover, another one early distribution. Could you specify what have you done with the funds? Okay. And in most cases, the person is going to say, well, listen, I had just one, let's say, a Roth account from which I simply converted it to, from the one that I had before to a new one. And that was indeed a direct rollover. However, I also did the backdoor. Okay. I also did the backdoor conversion. So you're going to see gross distribution, you're going to see taxable amount. What that tells you is that this used to be traditional IRA, traditional IRA. And you're gonna leave this as is. Okay, you're gonna leave that as is. What you're gonna do is you're gonna go to form 8606. First, to trigger it, you literally need to tell software that you want to actually trigger it. Okay, you want to trigger it. So you're gonna input one over here, otherwise the system's not gonna populate. What you also need to ask client is what was the value of all traditional accounts if you see, let's say, business, right? Or K1s, and you do see that there are some SEP IRA contributions, okay? Or some type of other IRA contributions that you're basically, that's a traditional IRA account, which frankly speaking, it's either traditional IRA or SEP IRA or sometimes simple. Simple applies to Schedule C. SEP is usually set up by pass-through entities, which will show up on line 13 of the K1. Okay, in the K1, there's going to be a code that basically tells you that the person contributed so much and so much into their retirement account. That's going to tell you that, let's say, they have also a SEP. If you see Schedule C, potentially, if we didn't write prior year tax return, and you see that there's a Schedule C, and then on Schedule 1, there is other adjustments for basically, different SEP um, or even simple, IRA contributions. Again, just ask for that value. Okay. If the person tells you they have a complex situation where they went ahead and they rolled over 401k into their traditional IRA, however, they only rolled over, backdoored, not rolled over, backdoored, let's say the amount that they have contributed in the year. So let's say from 401k, they rolled over into the traditional IRA $50,000. They contributed 7K directly to traditional IRA for the year because they can. Rollovers don't count towards contributions. So then they have a balance of 57 as of 12/31, 2024. Okay? There is that balance in the account. In that case, 57K would go here. How much did they backdoor? Well, let's just keep this number, okay? 15,144. This is how much they backdoored. In that case, we need to prorate what the bases are based on the basis that we gave that the person has in that traditional IRA account. By the way, guys, I know we're going through this super quick, okay? I know this is super quick that we're going through this. There will be a recording. You can pause it, you can re-listen to it, okay? If you're catching on right now, that's great. If you're not, don't worry, there will be a recording. So, um, at that point, when you're going to be looking at if there's something here, when you're looking at form 606 at this form, you will see that the person will not get the full amount of bases, okay, against this amount because the bases are going to be prorated and some of this amount is going to be taxable. But let's go back to this scenario. So we have marked one. We did see that the person actually moved, and you can just, for the ease of remembering what kind of number you put there, you put gross distribution. So on 8606, you always put gross distribution. This is how much the person is trying to convert to a Roth account. Okay, so this needs to always match whatever's in here, whatever gross distribution is. Okay? And then what do? We just double check ourselves. Well, does the person have enough bases? Did we miss something? We're going to go back to the adjustments to income. Okay. And we're going to look again. He made 7K here of the contribution to the traditional and he had prior basis. Ideally, when we click on preview tax return, let's go ahead and preview. Of course, it's going to take many hours later. Mhm. What you're gonna do, and from that screen, we can see that basically both spouses were doing it, right? So ideally, when you're previewing, you need to see 8606 for both spouses. Okay, and you're gonna see what do we have here? Well, enter your non-deductible contributions to traditional IRA for 2024. 7K. Beautiful. We know that they're above the threshold to where this is actually deductible. So 7K, good. Enter your bases in traditional IRAs in prior year. Okay, we know that they didn't qualify for Roth. So what's your logic? If they didn't qualify for Roth, it means that their income was above the 150 threshold. That's why they had to recharacterize, which means that it's definitely above 60K to where they could have potentially deducted some of the 65. So yes, 65 is going to be the basis for prior year. We then look, what's the total basis? Well, this plus this is going to be the total basis, 13,500. Verified, correct. Beautiful stuff. Then we go into here. Well, what did he actually backdoor? He backdoored 15,144. We check it against what? Against the bases. Bases are 13,500. Hence, what is the overage that he's going to be taxed on for this full amount then to be post-tax is going to be the difference between the bases, okay, and what he actually converted. So he's going to pay tax on this piece, and then this piece becomes post-tax, and it can peacefully grow together with the basis in the Roth account up until the person wants to go ahead and start taking it at retirement, at which point this is super important, guys. Not only the basis, but the full thing is going to be non-taxable. Okay, so for Roth account, when the person retires, when they draw from that account, not only the basis, but also earnings are not taxable. That's why people covet Roth plans. Are we on the same page? Please put thumbs up or
Yes.
glasses or whatnot. Okay. Okay. Sweet deal. Okay, awesome. Now, this is going to be in the recording. One caveat to this recording, and I think at the back, let's put them somehow close, right? And maybe name that this one is going to have a caveat to section 179. I'm just going to kind of bulk it in. I feel like we still have 4 minutes. I'm going to throw this super quick. So, the software is actually not as smart as I wanted it to be. Okay, no surprise there, but we'll deal with it. Section 179, we remember that it has to be a listed property, okay, which means personal tangible property, which means it's not literally personal, it's just that it's a property that usually has a class life of 5 or 7 years. Vehicles that are mixed use are also qualified tangible personal property that qualifies as listed. Hence, we can take Section 179. Why do people want to take Section 179? Well, because it's still, unlike bonus depreciation, which is for 2024 tax year, is going to be only 60%. It actually, for section 179, we can still take 100. So what you're gonna do is, for example, I'm not gonna actually type anything here not to mess up this tax return, but blah blah blah, I don't know, auto, okay? Auto, then we fill out class life. We're gonna connect it to the form. It's gonna populate activity number, let's say some kind of business, and it's like category automobiles. For example, you're gonna mark date placed in service, special depreciation allowance, yes or no. On this one, I would suggest putting yes. Okay, so click this one as yes. Okay, then cost basis, and this is where you will need to make a conscious choice and determine what is section 179 expense. By the way, there is a caveat to tangible personal property. Let's say mobile homes, they actually do qualify, but they're 15-year class life. Okay, so there could be a longer class life. If you guys are lost or confused, always message me and I'll let you know if it's actual personal tangible property. What you're gonna do, let's say basis, $50,000. Let's say it's a for some reason it's a piece of furniture that was just very, very overpriced. $50,000. Is it a personal tangible property? Yes, it is. Does it qualify for Section 179 expense? Yes. What do we know that Section 179 expense is? $50,000. Okay, $50,000. Now, what if it was a car, like we started? Let's say car was 50K. You're gonna go right away to the Mr. Google and you're gonna ask Mr. Google what is maximum section 179 depreciation that can be taken for autos, okay? For vehicles, it's gonna be limited. It's about 30,000. I don't know, maybe like 30,000, Again, Google that number. You can write it down, put like a post-it on your screen so you just don't have to constantly Google it. But if you do, that's fine too. Input that number. It's not going to equal what's over here. Okay, it's not going to be 50K. Remember, autos have different section 179 limitations. So you're going to put, let's say, $30,150. Okay, method, double declining balance over 5 years. We're good there. And when you're going to preview it, if the person was using vehicle 100% for business, it's going to show you that we're taking section 179, that amount, whatever, 30,000 something. If it is prior years, okay, prior years, there's other tests. We actually need to run a calculation. Is Section 79 better or is bonus depreciation better? And does the person qualify for bonus depreciation? Because remember, 80% of 50K could be more than 30,000 that we can take as 179. Okay, that's super important, you guys. However, for 2024, when we usually run, which one is higher, just maybe even quickly do the math. Well, what if the vehicle was 150,000? We know bonus is 60%. Well, 90, that's higher than 31, okay? Even if the person used it as 100%. So then what you want to do, you don't want to take Section 179. You do want to take special depreciation allowance, okay? And then you're going to fill the rest of this out. Autos are always going to be listed property, so you must check this. And then what you're gonna say, if the back seats of the car fold completely to where it mocks the flatbed of a truck, then it actually qualifies for bonus depreciation with no limits. You're gonna put two here so you can take 90K from the $150,000 vehicle. Now, if back seats don't fold, then it's not going to qualify for bonus depreciation because it's no longer machinery, it's actual auto. And then you're going to just stick to the 31K. Again, I know I went through this quickly. Can I get some, thumbs up, pluses, whatever that you guys understood? Okay. Okay, sweet deal. So it's 12. Some of you have client calls, so please take these. And I guess it's going to be a wrap unless you guys have questions.
I have a question about Ross IRA.
Okay.
Uh, I uploaded last year 5429 for 2023 for this client, Conklin. So
Hmm.
it says Ross contribution was 6 and 5, but there was no IRA contribution, meaning there was no traditional contribution, or there should be separate paper for that.
It just means that they qualified for a Roth IRA potentially that year. Uh, and you have Roth IRA conversion amount. So you see, this tells you that they basically were phasing out. You can see Roth IRA contribution 6,500 and it seems the Roth IRA conversion amount 5598. So it seems like they were phasing out. So even though they contributed to Roth IRA 6,500, they actually could contribute only the difference between 6,500 and 5,598. Meaning what they did is basically this now 5598 is actual non-deductible basis. It's 5598. So if we're gonna go here, deductions, adjustments to income, what we're gonna see is they, okay, uh, hmm, I don't think it goes here. I think it carried over, but I don't think it goes here. 5598, Roth IRA conversion amount, Roth IRA contributions. I think,
They said that they were beyond the limit. That's why they recharacterized this 650.
hold on, give me 1 second. Let me just check their prior year. Give me 1 second. I'll look back. Let's see. Let's see. Okay, so what we have here, that's not going to show us. Let's go here. Yeah, so they were definitely over that amount. So what happened was they contributed and then they realized that they actually couldn't contribute. Okay, so they recharacterized these amounts. This has nothing to do here. 5598. What did they recharacterize? They recharacterized into traditional, and now they're doing the backdoor. So IRA basis for 2023 and earlier years, technically speaking, would be whatever amount they then turned around and recharacterized. So this one is Daniel, so this is for the spouse. So technically, um, and it's odd, why did he do only 5598? Um, because if they have completely phased out, he should have done the full amount. So maybe what could have happened is the account just didn't do well and it went down really, really, in basically in value. However, since he's doing the back door, I mean, ideally this would be 55.98 because that's how much he moved.
They have 1099 R for this amount distribution in 2023.
Okay, so then maybe he contributed once he did the back door for the 55.98, or rather, it's a recharacterization and he has full basis in it. But basically, once he recharacterized 55.98, he could have probably added it to become a full 6,500 to match the contributions. So maybe at the end he contributed the full amount, like, to have basis 65. But from the looks of it, he actually didn't recharacterize the full amount. He recharacterized 55.98. So recharacterization actually um, should have been different. They contributed, but then they realized that it didn't go. So if anything, this needs to be 55.98 because this, I don't know if you guys can see this. 55.98 was the Roth IRA conversion amount, so he recharacterized it back into a traditional. Um, so ideally, this would be then 55.98, and then he's gonna have basis here of 55.98 for prior years. However, um, maybe he contributed more that year. I would ask him. I would say, "Hey, I saw that you recharacterized only, 5,598, but the total maximum, that ideally you should have had as basis would have been 6,500 because we do see that you contributed actual 6,500. Is there a reason why you didn't convert the full amount?" Okay, ask him that potentially.
Mhm.
And if the account has lost value, then you can actually restore the basis. You can actually put here that as intended, it was 6,500.
Okay.
Okay. What's also interesting about this, what could have happened, we could be looking at two events. So this actually could be tw for 2022 tax year. And this, well, it could be 20, yes, for 2022 tax year that was contributed in 2023. And this could be 2023 that was first contributed but then converted. So it could be basically two events we're looking at, not even the same event. This is where it's important to ask a client, you guys. Ask a client. We can't just assume based on the forms because according to this form, frankly speaking, it could go either way and we could potentially just restore to the full basis of the 6,500. What I'm trying to say. Okay. So
Okay.
always ask a client, oh, basically, could you tell me your story because they are living their life? And because contributions are allowed up until 415 of the following year, you always need to ask, hey, was this contribution intended for such and such year or for the current year? Hey, by the way, I do see that you did the conversion. Why was it this amount? Basically ask them about their life. Okay, you can't just assume that this is what happened. In a lot of cases, you can, if you see that the maximum contribution limit is 7,000 and you see the 1099 are for 7,000 and you see it's traditional IRA. Okay, well, the chances of that being backdoor conversion, is basically 99.9. Otherwise, why would they contribute and pull out? Doesn't make any sense. Okay. But if you
Okay.
see different numbers, like in this case, when we look at income, and we do see that it's kind of, close to what the 2-year basis would be, then yes, but also it seems like this is very inflated amount of earnings. So maybe ask them, hey guys, when you were doing these conversions, is it 2 years worth of contributions? Or not conversions, sorry, backdoor um, Roth IRA conversion, specify that it's backdoor. Otherwise, could be different types of conversions, right? So
Okay.
just specify, hey guys, I do see that it's a little bit higher than, potential maximum traditional IRA contributions for the 2 years. Could you please confirm that that's all contributions you had, and potentially ask them, and by the way, how much did you contribute each year? Okay, because what it also could be, guess what? It could be basis for 3 years in here. Because maybe for 2022, they were not that liquid and they contributed, I don't know, $2,000. For 2023, they could have contributed $5,000, and for 2024, they could have contributed whatever that difference is. Does that make sense?
Mm-hmm.
So we always must ask, you guys. We always must ask, and then from there, we basically fill in, the basis information in the deductions screen. Okay. Here, it's smooth. I mean, it's just form 8606, one, boom, has to match whatever you input here. The real work begins when you go into the deductions, adjustments to income, and you figure out, well, what are they contributing for the year we're filing that shows up here. Then you go into, is it deductible or not? You put that amount here. If it's not deductible, that's going to equal this, okay? And then this is the meaty part when you see large backdoor conversions, is figuring out this amount, what the actual bases are for prior years plus, let's say, the current year. Okay?
Mm.
Does that make more sense?
Yes.
Okay, does it make more sense for everybody besides the look back?
Yes.
Okay, awesome. Awesome.
I do have a question, Lily.
Mm-hmm.
You stated that whenever a person contributed in the Roth IRA, the distribution or withdrawals are not taxable, right?
When they retire.
Yeah. So if a person has contributed now in that Roth IRA, mean by backdoor Roth IRA, so will he be taxable at a state level on that amount that he distributed?
Well, is he retired and he's pulling out from
Not yet.
Roth IRA? Then no. Then you need to paraphrase your question because I'm not understanding your question. The contributions are never taxable, basically. If you just put money into the retirement account, it's not a taxable event. If you pull out, then it is. So if person before retirement age pulls out money from the Roth account, they're going to be penalized on the amount that is not basis. Then you need to go through the same exercise as if we're going through for basically traditional IRA. So let's say, I don't know, let's say the person is 30 years old. Okay, let's say they contributed
So
$5,000. I'm gonna finish and then you're gonna ask me, okay? So the person contributed $5,000. The amount was sitting there for 2 years. At the age of the 32, before their retirement, the person decides, hey, I really need that money for trip to Hawaii. At that point, the account is showing 5,400. The person pulls out 5,400. How much is taxable? Not only 400, which are earnings, are going to be taxable because he pulled it out before retirement age. Also, the 400 is going to be subject to 10% early withdrawal penalty. So the person is going to pay tax on the 400 and pay 10% early withdrawal penalty. Does that
yeah,
answer your
got it.
question?
Yes, yes, it answered my question.
Cool.
I do have a one case. Can I share here the link and can you please explain it from there?
Okay.
So,
Guys, whoever got the point and the gist, I feel like you can hop off. Also, I'm going to stop recording.